Hold on to your hats, folks, because Wall Street just got rocked. The Dow Jones Industrial Average took a nosedive on Friday, plummeting a gut-wrenching 600 points. What happened? The jobs report landed with a thud. It was way worse than anyone expected. This sent shockwaves through the market, sparking fears of a recession. Investors hate uncertainty. And this jobs report, it screamed uncertainty. When the economy looks shaky, investors get spooked. They start dumping stocks, and that's exactly what we saw on Friday. This wasn't just a blip, people. This was a full-blown market freakout. The Dow's freefall didn't happen in a vacuum. It was a ripple effect that sent shockwaves through the entire financial ecosystem. Investors, analysts, and traders alike were caught off guard by the sudden downturn, leading to a chaotic scene on trading floors across the globe. When the bell rang on Friday, the damage was widespread. The closing bell marked the end of a tumultuous trading day, but the repercussions were just beginning to unfold. The atmosphere was thick with tension as traders and investors tried to make sense of the day's events. The S&P 500, home to 500 of America's biggest companies, took a serious hit, dropping significantly. This index, often seen as a barometer for the overall health of the US economy, saw a sharp decline that sent ripples through various sectors. Companies across the board, from tech giants to industrial behemoths, felt the sting of the market's downturn. This index is considered a broader measure of the market than the Dow, and its decline confirmed that this wasn't just a few sectors taking a hit. It was a system-wide sell-off. Financial analysts scrambled to understand the underlying causes, debating whether this was a temporary blip or the start of a more prolonged downturn. The breadth of the decline suggested that investor sentiment had shifted dramatically, leading to widespread selling. The tech-heavy Nasdaq Composite, however, felt the heat even more intensely. Known for its concentration of high-growth, high-valuation tech giants, the Nasdaq has been a star performer in recent years. Companies like Apple, Amazon, and Google have driven the index to new heights, but on Friday, those gains were swiftly erased. This index, packed with high-growth, high-valuation tech giants, has been on a tear for years. The tech sector has been the darling of investors, attracting massive inflows of capital. However, the very factors that fueled its rise, high valuations and growth expectations, became its Achilles heel in the face of market uncertainty. But on Friday, those gains evaporated as investors hit the sell button. Panic set in as traders rushed to offload their positions, leading to a cascade of sell orders that further exacerbated the decline. The speed and intensity of the sell-off caught many by surprise, highlighting the fragility of market sentiment. The Nasdaq officially entered correction territory, tumbling more than 10% from its recent peak. This marked a significant shift in market dynamics as investors reassessed their risk tolerance and growth expectations. The correction served as a stark reminder of the volatility inherent in financial markets, particularly for high-flying sectors like technology. As the dust settled, market participants were left to ponder the road ahead, questioning whether this was a temporary setback or a harbinger of more turbulent times to come. When the stock market goes haywire, investors instinctively seek refuge. And in times like these, that refuge is often found in the comparatively stable world of bonds, particularly US Treasury bonds, considered one of the safest investments on the planet. As fear gripped the markets, investors dumped stocks and piled into bonds, driving up demand. Now here's the thing about bonds: as demand rises, yields fall. And boy, did they fall. The yield on the benchmark 10-year Treasury note, a key indicator of investor sentiment, plunged to its lowest point since December. Section 4. Rate cut debate heats up. Is the Fed fueling the fire or holding back the flood? This question has been at the forefront of economic discussions for months now. The Federal Reserve, America's central bank, has been aggressively raising interest rates to wrestle inflation under control. This strategy, while aimed at stabilizing prices, has had significant ripple effects across the economy. But with the economy showing signs of weakness and the market in freefall, many are questioning the wisdom of this approach. The stock market has been particularly volatile, with sharp declines causing widespread concern among investors. The debate over whether the Fed's gone too far is heating up. Economists and financial analysts are divided, with some arguing that the aggressive rate hikes are necessary to curb inflation, while others believe they are doing more harm than good. Some economists and market watchers are calling for the Fed to hit the brakes, suggesting that a more measured approach might be more appropriate. They argue that the current strategy could lead to unintended consequences, such as a severe economic downturn. arguing that further rate hikes will only stifle economic growth and potentially trigger a recession. These experts point to various indicators of economic slowdown. Retail sales have been sluggish and consumer confidence is waning, adding to the concerns. They believe a rate cut could be the shot in the arm the economy needs. Lowering interest rates could make borrowing cheaper, encouraging both consumers and businesses to spend and invest more freely. Boosting confidence and encouraging borrowing and investment, a rate cut could potentially reverse the current economic malaise. Proponents of this view argue that a more accommodative monetary policy would help stabilize the markets and support economic growth. On the other hand, the Federal Reserve maintains that its primary goal is to control inflation. Officials argue that without these rate hikes, inflation could spiral out of control, leading to even greater economic instability in the long run. Historical precedents show that unchecked inflation can erode purchasing power and lead to a host of economic problems. The Fed's stance is that short-term pain may be necessary to achieve long-term stability. As the debate rages on, economists continue to analyze data and make forecasts. The future of the economy remains uncertain, and the Fed's decisions in the coming months will be crucial in shaping the economic landscape. Public opinion is also divided, with some supporting the Fed's actions and others calling for a change in strategy. The impact of these decisions is felt not just in financial markets, but in the everyday lives of people across the country. Small businesses, families, and individuals are all affected by changes in interest rates. Higher rates can mean higher borrowing costs, which can impact everything from home loans to credit card debt. As night falls on the Federal Reserve building, the weight of these decisions looms large. The balance between controlling inflation and supporting economic growth is a delicate one, and the path forward is fraught with challenges. Yet there is hope that with careful consideration and strategic planning, the economy can navigate these turbulent times. Investors and policymakers alike are watching closely, hoping for signs of recovery and stability. The global implications of the Fed's actions cannot be ignored either. As the world's largest economy, the United States' monetary policy decisions have far-reaching effects on global financial markets and economies. International news outlets are closely monitoring the situation, and global stock exchanges react to every move made by the Fed. The interconnectedness of today's world means that the stakes are higher than ever. As the sun rises on a new day, the question remains: is the Fed fueling the fire or holding back the flood? Only time will tell, but one thing is certain. The decisions made today will shape the economic future for years to come. As Section 5, tech titans take a tumble, Amazon and Intel signal rough waters ahead. The tech sector, once considered invincible, is showing cracks in its armor. Investors fled tech stocks, sending valuations tumbling and sparking fears that the high-growth, high-valuation era for tech may be coming to an end. Amazon, the e-commerce and cloud computing behemoth, took a beating, with its shares plummeting over 8%. Concerns about slowing growth in its core businesses, coupled with a broader market sell-off, sent investors heading for the exits. Section 6, Meta shines bright in a sea of red, a glimmer of hope in uncertain times. Amidst the carnage on Wall Street, a beacon of hope emerged from the wreckage. Meta Platforms, the parent company of Facebook and Instagram, defied the market downturn, with its shares surging over 4% following a stellar earnings report. The social media giant exceeded analysts' expectations for both revenue and earnings, demonstrating its resilience and ability to navigate a challenging economic environment. Meta's strong performance was fueled by continued growth in its advertising business, particularly its success in monetizing its short-form video feature, Reels. Section 7, all eyes on the horizon. Can the upcoming jobs report calm the storm? After a week of gut-wrenching swings and shattered nerves, the market is holding its breath, anxiously awaiting the next major economic indicator, the upcoming jobs report. The volatility has been palpable, with investors on edge reacting to every piece of news with heightened sensitivity. The stakes are high, and the anticipation is almost tangible. This report, scheduled to be released next Friday, has taken on outsized importance, as it could either confirm investors' worst fears or offer a glimmer of hope that the economy is not headed for a nosedive. Analysts and economists have been poring over data trying to predict the outcome, but the uncertainty remains. The jobs report is more than just numbers. It's a barometer of economic health, a signal that can sway market sentiment dramatically. A strong jobs report with robust job growth and a low unemployment rate could be the antidote to the market's anxieties. It would suggest that businesses are hiring, consumer spending might remain strong, and the overall economic engine is still running smoothly. This could help to stabilize the markets, at least temporarily, and restore some confidence among jittery investors. It would signal that the economy is still chugging along, potentially easing fears of a recession and giving the Federal Reserve some breathing room on interest rates. The Fed has been walking a tightrope, balancing the need to control inflation without stifling economic growth. A positive jobs report could provide the justification they need to maintain or even lower interest rates, which would be a welcome relief for both businesses and consumers. On the other hand, a disappointing jobs report could exacerbate fears of an economic downturn. If job growth is sluggish or the unemployment rate ticks up, it could be seen as a sign that the economy is losing momentum. This could trigger a sell-off in the stock market as investors rush to minimize their losses. The ripple effects could be felt across various sectors from retail to manufacturing, as businesses brace for tougher times ahead. The upcoming jobs report is not just a statistic, it's a narrative that will shape the economic outlook for the coming months. Investors, policymakers, and everyday citizens will be watching closely, hoping for a sign that the stormy seas of the market might finally calm. The outcome will influence decisions on everything from hiring to spending, and its impact will be felt far beyond the trading floors. As we approach the release date, the tension is building. Financial news outlets are buzzing with speculation, and everyone is trying to read the tea leaves. Will the jobs report bring a sigh of relief or a new wave of anxiety? Only time will tell, but one thing is certain. All eyes are on the horizon, waiting to see if the upcoming jobs report can indeed calm the storm.